What's going on, guys, and welcome back to another video. Now, if you are a holder of Google shares, then I'm sure today that you are extremely happy with the results that they have just published. They just published their Q4 2021 results, and the stock is up almost 10% as a result of that. Now, I don't need to say this, but Google is not a small business. We're talking about a company with a market cap of $1.8 trillion. So to move almost 10% in the after hours is absolutely monumental. And the reason for that significant move is simply because their results were incredible. When I was reading through the report, I literally said to myself, wow. I just couldn't get over how well they had managed to perform and beat expectations, despite the fact that expectations were already set pretty high. Not only that, they also announced a 20-for-1 stock split, which I know a lot of people are going to be very interested in, what that means for them and what that means for the stock itself. So we're going to touch on that as well. So as always, we look to the headline news to get a general feel for what's going on with the business. And we can see here that Alphabet published earnings per share of $30.69, which was a beat by $3.39, or well over 10% on expectations. That is incredible. We come down to revenue, and they published revenue of $75 billion in a single quarter, which really goes to show you the scale of this business. And that was also a beat by $3 billion. Now, that revenue of $75 billion grew by 32% compared with the year earlier. And they had some really tough comparables. And despite that, they've managed to grow at 32%. Now, everybody generally thinks of Alphabet as simply a search engine in Google and then also YouTube, which is effectively another form of search engine, right? The fact of the matter is that they have their hands in so many different pies, and actually they don't get credit for all of the work that they're doing. We can see that from the CEO, he says here, our deep investment in AI technologies continues to drive extraordinary and helpful experiences for people and businesses across our most important products. So not only do they have their ad revenue through the likes of Google Search and YouTube, they've also got revenues from their cloud business. And then on top of that, they're also working in a number of different fields relating to AI. For example, their business Waymo, which is working on autonomous driving vehicles. Now, look, I'm not going to dive into all of the drivers of growth for this business and the potential that the business has, because I've done that in a previous video and I'll link that in the description below if you're interested, but we're just going to dive straight into the income statement. So here we've got the income statement, and we can see that this is for the 3 months to 2021, and then we've also got 2020 as a comparable there. As I said earlier, they published revenues of $75 billion in just 3 months, compared with $57 billion a year earlier. So that was growth of 32%. Now, the best thing, or one of the good things about this, right, is that their cost of revenues went from $26 billion to $33 billion. And as a percentage increase, that is a percentage increase of 27%. So revenues have increased by 32%, but the cost of delivering that revenue has only increased by 27%. That means that the business is more profitable today than it was a year ago, at least in terms of delivering that revenue. What we need to then do is come down to their operating expenses to see whether they've made any operational efficiencies there as well, and as a result, increased their total net income. So then we come down to research and development, and we can see that that has ticked up from $7 billion up to $8.7 billion. And anybody that's watched any of my previous videos will know that I am a huge advocate for businesses pumping money into research and development. Now, the reason for that is because research and development will allow them to develop new products. And as a result of that, that is later down the line going to effectively drive revenue growth. You need to see this line here as investment into the business rather than an expense. And then we come down to sales and marketing, and we can see that that has gone from $5.3 billion to $7.6 billion, which is actually a 43% increase. So then somebody might say, well, they've increased their sales and marketing by 43%, but actually their revenues have only increased by 32%. And I say only, right? That's just ridiculous, but their revenues have only increased by 32%. So isn't that an issue? And the answer is no, it's absolutely not an issue. And the reason for that is because their revenues have increased by something like $20 billion, right, or just under, and their sales and marketing have increased by $2.3 billion. Clearly, that is a worthwhile investment in pumping money into that sales and marketing. General and admin costs have more or less increased in line with revenue growth, and that is completely expected. As you sell more product, there's more admin to go along with that. So then we take that $75 billion in revenue that we generated, we subtract the total costs and expenses, and that gets us down to income from operations of $22 billion. You compare that to $15.6 billion for the year earlier, and that's a 40% increase. So their revenues have increased 32%, which is absolutely fantastic. But guess what? They've increased their profits by even more than that. So they're becoming more profitable despite the fact that they're actually selling more. We then have to account for around $2.5 billion of other income, subtract our taxes, and we get a net income of just under $21 billion. Absolutely phenomenal business. But how is that $21 billion in net income actually reflected as cash to the business? because as we all know, accounting standards mean that net income and free cash flow can be wildly different. And as a result of that, we also need to understand the free cash flows of the business. So we start with that $21 billion in net income. We make some adjustments for all non-cash items, whether that is income or expense. So for example, we add back the depreciation and amortization, because although that's an accounting expense, it's not actually a cash outflow from the business. Similar story with it relating to stock-based compensation. And then as a result of that, we get down to net cash provided by operating activities of $25 billion. We then take that $25 billion in net cash provided by operating activities. We subtract any purchases of property and equipment. That's your capital expenditure. We're looking at $6 billion there. We're left with free cash flow to the business of just under $19 billion. This is a free cash flow generating machine. In terms of what else they've done with that cash, well, they've purchased some marketable securities, so some treasury bonds, for example. That's a good move by management. They're clearly trying to protect themselves against inflation, and that is very important for this business, because when you see the cash balance of the business, you'll really understand why that could be an issue. Some of their marketable securities actually matured in the period, and as a result of that, they received $36 billion from that. But by and large, they spent $11 billion in investing activities. So $25 billion of cash has come into the business through their operating activities. They've spent $11 billion of that on investing activities. Clearly, they've still got some cash left, right? And so what do they do with that? Well, they repurchase some common stock, and that's a way of them returning value to the shareholder rather than using a dividend, which generally speaking isn't a tax efficient way of returning capital to investors. They've also had a little bit of debt restructuring as well, because we can see here that they've taken on some additional debt, but they've also repaid some debt pretty much by the same amount. So we've got $6.2 billion of debt taken on, and they also repaid $6.3 billion of debt. So the chances are is that actually they've just gotten a better rate on that element of debt. And then we come onto the balance sheet for the business. Now, I said that when we were going through the cash flow statement, it's very good to see that they were purchasing some marketable securities, particularly in this high interest rate environment. And I said that it's very important that this business is protecting against high inflation. Now, why is it so important for this business? We'll look at the total cash and cash equivalents balance that this business is holding. So this is as at 31st December 2021, $140 billion in cash and cash equivalent. You can literally count on one hand the amount of businesses in the entire world that is carrying that amount of cash. And as a result of that, it's very important, right, to protect themselves from high inflation. We saw earlier on that inflation came in at around 7% for the year. And as a result of that, we're losing 7% of purchasing power year over year. So what are Google doing to protect themselves against that? Well, they're purchasing some marketable securities in order to at least achieve a little bit of a return on that money. Now, considering that they've got $140 billion of cash, you wouldn't be stupid to assume that they may be carrying a lot of debt as well, right? Because that's what we tend to see. We see companies that have a significant amount of cash and then also a significant amount of debt, effectively offsetting that. That's not the case with Google. We come down here and we can see long-term debt, $15 billion, right? They've got some operating lease liabilities as well, which I account for as debt. But effectively, right, we're looking at around $25 billion in debt, right? And when you compare that to $140 billion of cash, I mean, I don't need to say anything regarding the financial health of this business. So the business has got total current assets of $188 billion compared with total current liabilities of $64 billion. They've got a current ratio of 3. That means that they'll be able to take those current assets and pay down those current liabilities 3 times over. Clearly, there's not going to be a liquidity issue for this business. So then we get onto the stock split. And I know that this is going to be a major talking point, and a lot of people are interested in what is going to happen. And the reason for that is because everybody will be very aware that when Tesla announced their stock split, the stock went on an absolute rally. And this had a lot of people confused. Now, there are two sort of school of thoughts to this. There are some people that say the business has not fundamentally changed, and as a result of that, there shouldn't be any change to the valuation of the business. And then there's another set of people that say that although the fundamentals of the business is unchanged, the technical setup of the business has significantly changed. And the reason for that is that effectively there are 2 key reasons. So the first of those reasons is emotional. Now, what do I mean by that? Well, first of all, we've got a stock price here of $3,000. And as a result of that, there will be some people, retail investors, that are new to the game and aren't aware of valuing businesses. They will look at $3,000 and think that that stock is way too expensive, right? And there are also people that don't have access to fractional shares, and therefore they may not have $3,000 to pump into a single stock. When we can clearly see here that there's a 20-for-1 stock split, that $3,000 stock now turns into a $150 stock, and all of a sudden the stock looks cheap to some retail investors, and as a result there's an increased volume of buying, which then drives the share price up in the short term. Now, this argument was always generally dismissed in previous years because we all know, right, that the vast amount of money being poured into stocks in trading is institutional. They will all be aware of how to value businesses, and as a result, the retail investors don't really move the dial. Actually, that's not the case in today's world, right, where effectively, I think I read that around 50% of money that is pumped into the market is retail investors. And therefore, retail investors as a collective really do have an influence on the market. I mean, we saw it with GameStop, right? And then the second reason is a slightly more technical one, and it's all to do with options. And effectively, if you're working with options, you have to commit enough capital to be able to buy or sell, depending on whether it's calls or puts, 100 shares of a particular stock. Now, if you wanted to play options with Google at the current price, well, you're looking at $3,000 times 100. How many people are going to want to do that, especially in the retail space? Not that many. You then think about a stock that's actually now valued at $150 a share. Well, then all of a sudden options become a lot more accessible to a lot more people. And as a result of that, there's an increased volume for this stock. Now, the stock isn't actually going to split until the 15th of July. Now, what's going to happen to the stock between now and then? Well, I don't know. And nobody does. And if anybody tells you that they do, then they're simply lying. So then that brings me on to my valuation model for the business. And we're talking about a $2 trillion business. So clearly it's not small, right? I've taken for years 1 and 2 revenue of $298 billion and $344 billion. And that is both taken directly from analyst estimates. So we're looking at revenue growth of 16% in each of those years. I'm then looking at revenue growth of 15% for the following 3 years, which will then fall down to 10% thereafter. Now, although the business has had a phenomenal year in 2021, clearly 41% revenue growth is not the norm for this business. And when you look across the historical period, we're looking at somewhere between effectively 15 and 20% on average, right? So I think that my estimates are probably fair for the business. To give you some perspective on those numbers, we're going to go from revenue of $257 billion in 2021 all the way up to $850 billion by 2031. So although the percentage growth figures aren't absolutely huge, when it's on working on such large numbers, it really does start to add up. Gross margins have remained relatively stable across a historical period, and as a result of that, I'm just using the average across the 5 years, which is 57%, which also happens to be the gross margin that they achieved in the most recent year. For operating expenses as a percentage of revenue, they actually saw a significant decline in 2021, and you can see that the average for the 4 years prior to that was actually 33%. Despite that, I do think that they can continue to operate at this kind of efficiency. And as a result of that, we're looking at operating expenses as a percentage of revenue of 26%. After taking into account their non-operating income as well as taxes, we're looking at a net profit margin of 30%, which is effectively in line with what they achieved in the previous year. And as a result of that, we're expecting net profit to go from $76 billion right the way up to $238 billion by 2031. That then brings me on to my discounted cash flow. And we can see here that their EBITDA margin average over the last 5 years was 32%. But I'm actually projecting for them to be able to retain their most recent result, which was 35%, going forward into the future. Now, in terms of unlevered free cash flow as a percentage of EBITDA, their historical average has actually been 50%, but in their most recent year, they've actually achieved 61%. And as a result of that, I think that they can continue to achieve that level of efficiencies going forward. And therefore, that's what I've been projecting in my model. That then brings us to the current fair value of the business. And we can see here that according to the discounted cash flow, we're looking at $2,762. And according to a multiple of earnings in 10 years time of 20. Now, the reason for 20 is because Google is such a solid business. It has high net profit margins. It still grows at a decent rate. And not only that, it has a massive moat. So P/E ratio of 20 is a fair estimate in my opinion. As a result of that, we get a price per share in 10 years of $7,500, which today is worth around $3,100. We get a fair value per share when we take the average of the two of $2,924, which is effectively fairly valued, right? We're coming up here as a negative 2.7% margin of safety. Ultimately, that's fair value. So then that sort of brings me on to the quote by one of the most successful investors to have ever lived, which is, of course, Warren Buffett. And he says that it is better to buy a wonderful business at a fair price than a fair business at a wonderful price. And I think Google is a great demonstration of that. Now, of course, just because a business is fairly valued, that doesn't mean that you're not going to see a return on your investment. As a result of that, I also look at a 2026 price target for the business, and we use an enterprise value to EBITDA multiple of 17. We get a price target of $5,100 by 2026, which would be a compounded annual growth rate of 12.6%. After we also take into consideration the share buybacks that the business commonly employs. Now, in terms of my rationale for using an enterprise value to EBITDA multiple of 17 in 5 years' time, well, if we look to the historical average of the business over the last 10 years, investors have been willing to pay, on average, 17 times EBITDA. As a result of that, I think I can say with a fair amount of confidence that in 5 years' time, investors will still be willing to pay around that sort of multiple. And as a result of that, I think it's a fair target. So I'd love to hear your thoughts on the business and whether you are an investor in Google or not. Anyway, guys, I hope you've enjoyed the video. And until next time, thank you.